Want to invest but think you need a fortune to get started? They began. In this video, I'll show you how to start investing with little money, even if you're on a tight budget. Whether it's $10, $50, or $100, you can grow your wealth starting today. And if you're serious about building your financial future, don't forget to hit that subscribe button for more smart money tips every week. Let's dive in. Investing is often seen as something only the wealthy can do, but that's a myth. Thanks to modern tools and platforms, you can begin investing with just a few dollars. The earlier you start, the better your chances of building long-term wealth, even if you're starting small. This guide breaks down the 10 most practical steps to start investing with little money. 10. Understand the power of time over amount. Many people think they need thousands of dollars to begin investing, but in reality, time matters more than how much you invest initially. Compound interest is your most powerful ally. For example, investing just $25 to $50 per month starting in your 20s can result in a six-figure portfolio by the time you reach retirement, even without huge returns. The earlier you begin, the longer your money has to grow. Waiting until you have a large amount to invest may cost you valuable time that could have been spent earning compound returns. 9. Set clear and realistic financial goals. Before you invest a single dollar, it's important to know why you're doing it. Are you investing for retirement, a down payment on a house, early financial independence, or your children's education? Your investment timeline and risk tolerance will depend on your goals. Short-term goals might require safer investments like bonds or high-yield savings accounts, while long-term goals allow for more aggressive investments like stocks or index funds. Having a purpose behind your investment will help you stay focused and avoid emotional decisions when the market fluctuates. 8. Build a strong financial foundation first. Investing is essential, but it shouldn't come at the cost of your financial stability. Before you begin, make sure you created a basic budget and are managing your expenses wisely. Eliminate high-interest debt like credit cards, and build an emergency fund that covers 3 to 6 months of your living expenses. This safety net ensures you won't have to liquidate your investments prematurely if an unexpected expense arises. Once your financial base is solid, you're ready to begin investing with peace of mind. 7. Choose the right investment account for your needs. You can't invest in stocks or ETFs with a regular checking account. You need to open an investment account, and choosing the right one is crucial. For general investing, a taxable brokerage account is a flexible option, letting you withdraw anytime. If your goal is long-term retirement savings, consider opening a Roth IRA or traditional IRA, which offer tax advantages. Today, many brokers like Fidelity, Charles Schwab, Robinhood, and Webull allow you to open accounts with zero minimum deposit and no commission fees. This makes it easier than ever to get started with little money. 6. Take advantage of fractional shares and ETFs. If the idea of buying an entire share of Tesla or Amazon seems out of reach, don't worry. Fractional investing allows you to buy a piece of a share for as little as $1. This is a game changer for new investors with limited capital. Another powerful tool is ETFs, or exchange-traded funds, which allow you to invest in a diversified portfolio of companies with a single purchase. Index funds like the S&P 500 ETF give you exposure to hundreds of stocks at once, minimizing risk. Platforms such as Fidelity, Public, and M1 Finance offer access to both ETFs and fractional shares, making diversification easy, even on a tight budget. 5. Use micro-investing platforms to start small. Micro-investing apps like Acorns, Stash, and SoFi Invest make investing feel accessible and unintimidating. These platforms allow you to start investing with as little as $1 and offer automated investment options. For instance, Acorns rounds up your everyday purchases and invests the spare change, while Stash helps you invest small amounts and learn along the way. These platforms are great for those who feel overwhelmed by traditional brokers or are still learning the ropes. While the returns won't be massive at first, they help you build the habit of investing regularly. 4. Automate your investments for consistency. One of the most important habits you can develop as a new investor is consistency. Even if you're only investing $10 a week, automating your contributions ensures you stick to your plan. Most investment apps and brokerages allow you to set up recurring deposits, taking the decision-making and temptation out of the process. You're more likely to succeed when investing becomes a routine. This also prevents you from trying to time the market, which even expert investors struggle to do successfully. Automated investing ensures you're buying in regularly and building wealth gradually. 3. Reinvest your dividends and let compounding work. Many investments pay dividends, regular payments made to shareholders from a company's profits. When you're starting small, it may be tempting to take those payouts as cash. But a better strategy is to reinvest those dividends, buying more shares, and increasing the size of your investment. Over time, this compounding effect can significantly boost your total returns. Many brokers and robo-advisors offer automatic dividend reinvestment plans, DRIPs, that take care of this for you. It's one of the most efficient ways to grow a portfolio from a modest starting point. 2. Continue learning and avoid emotional decisions. Investing is simple, but it's not always easy, especially when markets drop or news headlines turn negative. The best investors aren't necessarily the smartest, but the most disciplined. By learning basic investing principles, understanding market trends, and keeping emotions in check, you can avoid panic selling or buying into hype. Follow trusted educational resources like The Motley Fool Investopedia or financial YouTubers and podcasters. Read books like The Little Book of Common Sense Investing by John Bogle or Rich Dad Poor Dad by Robert Kiyosaki. Education gives you confidence, and confidence leads to better investment decisions. 1. Just start, even if it's with $5. The biggest hurdle for most new investors is taking that first step. You may think it's not worth investing $5 or $10, but it absolutely is. Starting small teaches you how markets work, helps you build habits, and lets you get comfortable with risk and returns. With modern technology, there's no excuse not to begin. There are zero-commission brokers, fractional shares, micro-investing apps, and educational tools at your fingertips. The sooner you begin, the more time your money has to grow. Don't wait until you have enough. Start with what you have now. What do you think of our video? Let me know in the comments section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.